Hey, welcome to the show. It's Captain Seth with your Uncle Paul. We're here as always analyzing stocks, real estate, business investments, business moves. But in this case, we're going to get in the zone here and analyze AutoZone. You asked for it, you got it. Our patrons were asking about this. Paul did some research on this. We're going to bring you the ins and outs of this company, what is defining its stock price, what is going on with the health of its financials behind this company. And my side piece, Paul, is going to go into talking about all the ins and outs of AutoZone with his pretty little mouth. Paul, how are you?
I am wonderful, Seth.
We had a beautiful
dinner last night.
We had a beautiful dinner. We had a beautiful dinner last night.
Why is that funny?
Discussing the show, and I don't know, it was just great. It was nice.
And giving crap to the waitress.
You love doing that.
Love it, but in a good way. It's a very positive way. I'm not being mean about it. I just, like the one, the second waitress that came by to give you pepper on your. She comes to my side. Goes, sir, would you like pepper on your salad? Well, she first went to Seth, and she came to me. I said yes. She goes, okay, say when.
So she starts grinding.
And then all of a sudden Seth says something, and she just leaves me and goes to Seth, and I was like, I didn't say when.
So she just, I'm sorry, turns back, and right as she cranks up, he goes, when?
Yeah, as soon as she's already done, like, when? We're good.
Anyway, let's look at.
I did want more pepper, by the way.
Let's look at AutoZone. We're going to use our 8 pillars to look at this company. We're going to look at the PE, the market cap, the profit margin, revenue, profit, all the shares. Let's get it done. And
the real financial stuff, the stuff that really matters when it comes to buying good investments that are going to perform well over long periods of time.
Now, I was shocked just in general that the stock is trading at over $1,200. I don't know why. We rarely look at the price, but let's get after the 8 pillars because we know the price doesn't matter at the moment. What is the market cap for AutoZone, baby?
$28 billion company.
It's nice.
PE, 16.25. So immediately a check mark. We want them under 20. Not that we think 20 is a good price, but it's a good starting point to look at and say, hey, same thing with price to free cash flow. We want to start at that point.
What is the profit margin? I would think it'd be low.
I would thought so too.
Wow,
14%.
14%. That's really good.
That's a good check. And the gross margin, 53%. So every product they sell, 53% of that product's sales go to the bottom line.
This is in 6,400 stores nationwide. Amazing.
Yep.
Revenue growth over the past 5 years. What is it,
let's
baby?
check out our revenue growth. So far we have 2 check marks.
Love it.
Revenue growth has been awesome. Revenue growth has been 10.64 to 12.63. Chickadee check right there. Very consistently growing. 10.64, 10.89, 11.2, 11.9, 12.6.
Is this slow growth or nice growth?
So to me, it's nice growth in the sense of it's a small company, it's a big company, has a lot of 6,500 locations around the world, growing a lot in Mexico and Brazil, and still showing good growth. And I'll get into that in a little bit on how I'm looking at the revenue growth numbers and the profit growth numbers.
Lovely. Let's look at profit growth. Pillar number 4.
1.24 to 1.73. That's right there.
Yeah, that's good.
Yep. So we're, one of the things I'm trying to do here is we've done AutoZone in the past. We're trying to do a little more detailed analysis on this company to understand better how it looks.
Pillar number 5 is shares outstanding with the shares going down.
I love this.
Oh boy.
30 million, 23.5. Big time check.
This is 5 straight checks, Paul.
Look at 2012. They had 38 million. They're down like freaking 40% on their shares in the last 10 years. That's going to matter a lot when it comes to looking at your earnings per share, which we'll get into as more detail.
Let's look at current assets greater than current liabilities, which is pillar number 6, Paul.
Current assets, 6.84 billion, so call it 6.8 billion. Current liabilities, 6.45. Check mark there.
Still good there. 6 straight check marks. Free cash flow, the granddaddy of them all, your favorite pillar, pillar number 7. Let's look at this free cash flow.
And the one thing I like here is remember, free cash flow is cash from operations less your capital expenditures. Companies will use their free cash flow to pay dividends, buy back shares, make major acquisitions, invest back in the business to keep it growing. That's going to matter a lot and one of the metrics I'm going to tell you about. But here, the one thing I like to see businesses that don't need to spend a big chunk of their capital expenditures, a big chunk of their operating cash on capital expenditures. If it's high, it shows that you need to keep reinvesting in the business just to maintain it. We don't want it to be too high. Look at this. This is about 33%. This is pretty good. In fact, later it gets to like less than 20%. So here we have 1.1 billion, and here we have 2.3 billion. Massive check mark.
Wow.
Okay, now we want an average 1 billion, 1.5 billion, and 1.6 billion.
So the average free cash flow over the past 5 years is $1.5 billion.
Times 20, $30 billion.
This is the desired market cap that you want AutoZone to be worth in your mind through your analysis and opinion?
So we talked about PE being less than 20. So free cash flow and earnings should be the same over long periods of time. So I'm okay multiplied by the same 20. And it's not to say this is what it's worth. It's to say, are we in the ballpark? What was the market cap?
28 billion.
So we are in the ballpark. So this is a company that if we were to stop the video right now, I'd say, guys, I like everything I'm seeing. It's all check marks. We had all check marks,
all
right?
check marks,
all
baby.
check marks. All 8 pillars are hit. This is the time to go do more due diligence and figure out, do you want to buy this company or not? Okay? Now, there are some big metrics I want to discuss here that matter a lot to the company and to me when it comes to doing a deeper dive. Part of this video to do a deeper dive. Keep in mind, everybody, we have a Patreon. If you like these financials, if you like the 8 pillars, if you sign up for our Patreon any level, you get our website, which will be available in April for free. The sooner you sign up, the cheaper it is.
Yep.
In addition to that, these very specific videos will only be going to the Patreon members.
Yep.
So sign up for the Patreon. It's well worth it. If you have $10,000 in a bank account that you're trying to invest with, the $8 Patreon level is well worth it. You'll get this as long as you're a Patreon member, all for free.
Yep.
Okay, so a big metric I look at that Joel Greenblatt looks at
Yep.
is return on assets.
Okay.
So this is basically how well does the company do making money on the assets it has, okay? The S&P on average has a return on assets of 5.4%, okay? AutoZone, 13.4%.
Wow, that's massive.
Much better, right? 13.5%, sorry. Okay, so that's a big thing that he loves. He likes to look at how good are they at making money on the assets they have. Another metric, return on invested capital. This is what kind of return are they getting? This is what I personally like on the money they're putting out there. Okay, if they're going to take their cash flow, that free cash flow, and reinvest it back in the business, how good are they at making extra money?
Oh yeah, you do love this.
I do love this. S&P, the average is 9.4%. Ready? AZO, AutoZone, 45.3%.
What does that tell me as a normal person, these numbers?
This tells you they have a big cash flow number, and they're able to take that cash flow and make massive returns on that cash flow. That is huge. The other thing about the return on assets, it's return on AutoZone owns a big chunk of the stores, the buildings they're in. So that's a big number of assets, and they're able to make a very high return on those assets. That's very, very, very good for a company like that. These are major check marks to me. Now, these aren't part of the 8 pillars, but these are incredible check marks to me and very important for you to understand that the hardest part for most CEOs is reinvesting the capital of their company. Most CEOs don't get that that is their job. Their job is to figure out how to allocate their capital properly to provide returns to investors, okay? Now, let's look at these numbers also. So I'm gonna look back at 2000. One of the interesting things I found out about this company, AutoZone, is they tend to do big jumps during recessions. And I think the reason being, the theory out there is when people are in recessions, they tend to, instead of buying new stuff, buying new cars, put money back into their cars. Mm-hmm. So most someone would think, oh great, but you come out of recession and it dips. The interesting thing about AutoZone going back the last 25 years, every recession, they have a big, nice spike in revenue and it doesn't go back down. It's a new level of plateau that they build from. That's what I like about AutoZone. So it's almost like revenues are beneficial for them to give them a new boost. If you look at this most recent recession, they had a big jump in the last 12 months in their revenue. If you go back to their revenue here, they did 12.63, but let's go trailing 12 months, almost $13 billion. So they had a nice jump in revenue in the last year after the recession. So that's something that's very, very hard to find. Okay, a couple other things. They had 4,600, in 2010, they had 4,600 stores, roughly. Now they have 6,500. Mm-hmm. That's growth of 3.5% a year. Their revenue, though, in that same time period, has been 5.5% a year in growth. So they didn't just rely on stores. They had to also rely on growth within the stores, which I like. That's a very good factor. So you'd be concerned if they're growing stores at 3.5% and their revenue is growing at 2.5%.
You brought this up when we talked about Best Buy, is that
yes.
they're increasing stores, but maybe not necessarily increasing the profit from the same stores.
Or this is revenue.
Revenue, I meant, yeah.
Correct, exactly. Now the profit's even better The profit back in 2010 was 738 million or so. Did I get that number right? 738. And last year it was 1.74 billion. That's growth of 8.8% a year. So they're growing their stores at 3.5%. They're growing their revenue at 5.5%, but they're growing their profit at 8.8%. That's very strong. I think this justifies the whole 20 times free cash flow. Now, going further, earnings per share. This is something we haven't talked about because it's more, somebody asked me about this in the Patreon, in the Discord chat. They said, Paul, why don't you look at EPS? I want to find a business. When shares are decreasing, earnings per share goes up, right? Because if you have $10 in earnings and you have 5 shares, that's $2 a share, right? Mm-hmm. If all of a sudden you go down to 4 shares, that's $2.50 a share. So you can make earnings per share go higher just by decreasing the number of shares.
Which they're doing in AutoZone.
Which they're doing, but that's why I look at the total numbers. I want to make sure the company is able to grow itself without having to drive shares down. So back in 2010, they had about $15 a share in earnings. Now, 78.
Wow.
That's growth of 17.7% per year per share. Guys, this is astronomical. So, not only are they investing their capital well, they're getting a good return on their assets, and they're using the money to make your investment better. Every single year, they're buying back more shares so that you own a bigger piece of the pie. Somebody in Patreon gave me a great idea. What they're doing here is you have a pizza pie. When it comes to shares, you have a pie cut into 4 pieces. When you issue more shares, you're just cutting the pizza up into smaller pieces. When you're buying back shares, there's now less slices. The same thing, you're getting a bigger piece of it now. That's the way to look at shares being bought back. So when they're buying back their shares, you're getting an increase per share in the amount of profit and revenue that the company's making. That is huge. So they're getting 17.7% increase in the earnings per share. Okay? Profit margin. In 2010, their profit margin was about 9%. Today, 14%. Mm-hmm. Guys, this is a physical retail location. This is going awesome. They're going from 9% to 14% in their profit margin.
I mean, they're selling the same thing as their competitors. Napa, Advanced, they're just selling the same
Yeah,
products.
I looked at some other stores, and I like these financials a lot.
I wonder why they're doing it so much better.
I don't know.
They have won the marketing game.
Well,
when you think about Advanced AutoZone or Napa or something
Advanced Auto Parts.
Advanced
Auto.
Auto.
Some names.
Yeah, listen to me. Yeah, AutoZone has got the marketing down.
Now, what are the cons to AutoZone?
Uh-oh.
I think there are 2 big cons they have to watch for. Everything is Amazon. Like, they got to fight Amazon on making sure that, like, do you go to AutoZone? I go to AutoZone.
Yeah, because sometimes they'll install parts for you, or sometimes you need to take in a broken part.
And they're knowledgeable.
Yes.
Hey, I don't get this. You're not getting that from Amazon.
No.
Right?
There's no knowledge at all. You got to find the stuff yourself.
EV, electric vehicles. I'm sure they're going to adapt and provide more for electric cars and things like that. And I'm sure all that stuff. But I'm worried about, I think of myself, okay, what about EV? Now, I'm being ignorant by saying that just because they're electric vehicles doesn't mean that they're going to stop selling parts. I mean, Tesla, when you have a part broken with Tesla.
Well, that's the weird part is Tesla doesn't let you fix your own Tesla.
Correct.
Yeah, so they don't, so that's tough.
So these are the big issues I see. Actually, not this as much, because I think you go to AutoZone when you need help. It's this I'm more concerned about. I am more concerned about the electric vehicle market. That's it. Overall, though, guys, I think buying it at this level today, you will do fine. Do more due diligence. I personally, as a value investor, want to see a much higher premium in my investment. So I'm trying to buy it around $1,000 a share or lower.
It's currently $1,240.
Yep, it was at $750 in the bubble burst in March, right?
Yeah.
Okay, the crash of March. I'm a big fan of this. I think you should keep your eye on this one. Yes, the shares price is very, very high. So most of you won't be buying many shares, if any at all. But in terms of a company that I think is looking great from a financial perspective, I had a hard time finding a negative on their financial statements. Mm-hmm. That was the hard part for me. They have their own product lines, which have higher margins. Their gross margin's high. I just liked it overall as a company.
If you like what you're hearing and this resonates, go ahead and tickle that thumbs up. Paul loves to be tickled, as we've described before. Subscribe if this is the first time you've ever seen our videos. And as always, you can check the description below to join our Patreon. This was one of the requests off our Patreon line. Paul talks to patrons all day, and we have exciting plans for Patreon moving forward. In our channel in general, our dinner last night was talking about how Paul and I would be doing this a lot more, bringing you a lot more videos.
And focusing on the patrons. Our goal is to focus on making sure this channel is dedicated to the patrons. 2
of the patrons this year will be receiving Tesla Model 3s. Uncle Paul will be swiping his credit card and delivering 2 Teslas to 2 of you somewhere in this world.
It'll be a giveaway for 2 Model 3 Teslas. When we hit 50,000 subscribers and 100,000 subscribers, we'll be giving away a Model 3 Tesla.
It'd be incredible.
It'll be awesome.
Thanks for joining us. We love you guys. Thanks for the support. And follow along on this amazing journey of stock analysis. See you guys. Appreciate it.